You know what nobody tells you about your 30s? This is the decade where money really starts to count, and mistakes start costing you big. One wrong move can keep you stuck for years, but one smart decision can change your entire future. Your 30s are not about surviving, they're about building. This is when compound interest, better habits, and smart choices start to pay off in ways you can actually feel. If you want your 40s to be about freedom instead of financial stress, here are the major money milestones you need to hit in your 30s. Number 1. Wipe out all high-interest debt. Alright, let's start with something most people in their 30s don't like to talk about. Debt. If you're in this decade of life, you probably have a mix of things going on. A decent job, maybe a car loan, a few credit card balances, or some leftover student loans. It's all normal, but here's the truth. Not all debt is created equal. The kind that really hurts you is high-interest debt. Credit card companies are charging insane rates right now, usually around 22 to 25%. That means if you owe $10,000 and keep paying only the minimum, you could end up paying more than double that over time. You're basically giving your debt a luxury vacation at your expense. Your 30s are when compound interest should finally start working for you, not against you. So, it's time to flip the situation. The best way to do that is through what's called the debt avalanche method. It's simple. You list all your debts from the highest interest rate to the lowest and focus on wiping out the top one first. When that's done, move on to the next. And don't panic about things like mortgages or low-interest student loans. Those are long-term commitments that can actually help build stability. The real problem is credit cards and personal loans that quietly eat away at your income. Paying them off isn't just about saving money. It's about freeing up your future. Number 2. Hit a credit score of 780. Now that your high-interest debt is out of the way, let's talk about something that secretly controls how expensive your life becomes. Your credit score. Most people don't think about it until it's too late, but this little number decides how much you'll pay for your home, your car, and even your insurance. A credit score above 780 is considered excellent. According to Experian, people in this range qualify for the lowest interest rates. To give you an idea, if you buy a $400,000 home, the difference between having a 720 score and an 800 score could cost you around $40,000 more in interest over a 30-year mortgage. That's basically the price of a brand new car, gone because of a weaker score. So here's how you build and keep a solid score. First, never miss a payment. Even one late bill can drop your score by more than 100 points and stay on your record for years. Automate your payments if you have to. Second, keep your credit utilization below 10%. If your limit is $10,000, try not to use more than $1,000. It shows lenders you're responsible with credit. Third, don't close your oldest accounts. The longer your credit history, the better your score looks. Even if you rarely use that old card, keep it active with small purchases. Your credit score is basically your financial reputation. The better it is, the cheaper your life becomes. So treat it like gold, because it can quietly save you thousands without you even realizing it. Number 3. Build a 6 to 12-month emergency fund. Let's be honest, life in your 30s isn't as simple as it was in your 20s. Back then, you could survive a rough patch with a few $100 and some instant noodles. But now, one unexpected expense can throw everything off balance. That's why having a proper emergency fund is so important. In your 20s, saving around 3 months of expenses might have been enough. But once you hit your 30s, the game changes. You need a bigger cushion, ideally 6 to 12 months of living costs. The reason is simple. Job changes take longer, medical bills are more expensive, and family responsibilities don't wait for your paycheck. Let's put that into perspective. If your monthly expenses are $2,000, you should have around $12,000 saved for emergencies. It might sound like a lot, but it's what keeps you from falling back into debt when life surprises you. Now, where should you keep this money? The best place is a high-yield savings account. This isn't about chasing profits. It's about having quick access to cash when you really need it. You're not trying to grow this money, you're keeping it safe and ready. An emergency fund is more than just savings, it's your peace of mind. It means you can handle life's problems without panicking or borrowing. When things go wrong, this fund makes sure your plans stay on track and your stress stays low. Number 4. Have 2 to 3 times your annual salary saved for retirement. Now that your emergency fund is sorted, it's time to look a bit further down the road. I know the word retirement feels like something way in the future, but here's the reality. Your 60s will come around quicker than you think. The choices you make right now in your 30s decide whether you'll retire comfortably or still be working just to pay bills. By the time you reach 40, you should aim to have around 2 to 3 times your annual salary saved for retirement. So if you make $60,000 a year, your goal should be somewhere between $120,000 and $180,000 invested. It might sound like a big number, but it's completely achievable if you start early and stay consistent. You don't need to be a financial expert to get this right. Whether it's through a 401k, an IRA, or even index funds, the secret is simple. Start now and keep adding. The earlier your money starts compounding, the more powerful it becomes. For example, if you invest $500 every month starting at age 30 with a 7% return, you'll have around $600,000 by age 60. If you wait until 40 to start, that number drops by nearly half. Make it easy for yourself. Automate your contributions so you're saving without thinking about it. And every time you get a raise, increase how much you put aside. Even a small bump each year can make a massive difference later. Number 5. Lock in the right insurance coverage. You've built savings, invested for the future, and created a safety net. Now it's time to protect it. Insurance in your 30s isn't optional, it's essential. One unexpected event can undo everything you've worked for. Start with health insurance. Medical debt is one of the top reasons people go broke. A simple hospital visit can cost thousands of dollars. Good coverage keeps that from becoming your problem. Next is disability insurance. Most people skip it, but it's what pays your bills if you get injured or sick and can't work. Your income is your biggest asset, so protect it. If anyone depends on you, get life insurance. Term life is the smartest option because it's affordable and gives strong protection for the years your income matters most. It ensures your family won't struggle if something happens to you. Then there's renters or homeowners insurance. Fires, theft, or accidents can happen anytime. This coverage replaces your belongings and keeps you from draining your savings to start over. The purpose of insurance isn't to cover every little inconvenience. It's to protect you from the big events that can destroy your finances. You don't need every policy, but you do need the right ones. Insurance doesn't make you paranoid, it makes you prepared. It's how you make sure one bad day doesn't erase years of progress. Number 6. Start investing beyond retirement accounts. Once your retirement plan is rolling, it's time to look beyond it. Your 30s are the best time to start building real wealth through other investments. Relying only on your employer's 401k limits your potential. You need your money working for you in more than one place. Start by opening a brokerage account. It gives you full control and flexibility to invest in low-cost ETFs or index funds. These track the market and grow steadily over time without the stress of constant trading. Even small monthly investments can grow into something big. For example, investing $300 a month with a 7% return can become over $350,000 in 30 years. You can also explore real estate if it fits your goals. A rental property, or REIT, real estate investment trust, can bring in steady cash flow while your property value grows. It's one of the best ways to build long-term passive income. If you're more entrepreneurial, think about investing in a side business. It doesn't need to replace your job, but it can create an extra income stream that supports your financial goals. The most important rule is consistency. Don't wait for the perfect time to invest. It doesn't exist. The earlier you start, the longer compounding works in your favor. Your 30s are the decade where you build your financial foundation. Every smart move you make now multiplies over time. It's not about being perfect, it's about being consistent. Each debt you clear, each dollar you invest, and each habit you build quietly compounds. Not just in your bank account, but in your mindset too. The goal isn't to become rich overnight. It's to create stability, freedom, and peace of mind. When you build systems, automate your savings, and let discipline guide your decisions, Wealth becomes a natural outcome, not a constant struggle. Start ticking off these milestones one step at a time. By the time you hit your 40s, you'll thank yourself for every smart decision you made today. If you found this guide helpful and want more practical tips to grow your money and mindset, make sure to subscribe to the channel and turn on notifications. There's a lot more coming your way to help you live smarter and stress-free. This is MindCraft, where ideas become action, and action becomes your future.